Hello dear students, this is Professor Agam Dalal and I welcome on behalf of JK Shah classes to all of you in this particular video. Now why this video and to whom this is applicable? First of all, this video is solely applicable to the students who are going to appear in January 2026 attempt CA final. For you, Institute has issued a statutory updates for direct tax and international taxation, that is your paper number 4. Now let me give you one overall guidance. This is a 72 pager statutory update PDF as you can see over here on the screen, which I will be summarizing over here in just 7 pages plus some more pages which were earlier issued. Now let me tell you how you are going to study and what all the things you are supposed to study after this particular video so that you get a clarity. Let me be very much clear once again. For September 25 students, this video is not applicable. To them, the video which was earlier uploaded is applicable. To January 2026 student, this video is applicable. CA final direct tax. Now, first of all, you all are aware about that your previous year is 2024-25, relevant assessment year is 25-26. I will be quick enough and to the point so that your time is not getting wasted. To you, two budgets are applicable. First is Finance Act 2024 number 1, which was issued on 1st February 2024, and the second one is 2024 number 2, and this particular second budget was issued on 23rd July 2024. Now whatever are the amendments covered by these two budgets are already discussed in the lectures itself. So the first budget was already merged with the lectures. The second budget amendments were already discussed in the lectures, in the last lectures, which were around of 6 to 7 hours. We have just discussed all the amendments, though maybe of capital gain, of buyback or whatever it may be. All the amendments were discussed particularly. And that particular amendment video I have already uploaded on the YouTube much earlier, 2 to 3 months before. Then what ICI has done, it has issued two separate PDF, that is statutory updates and judicial pronouncement for September 2025 students. So whatever was discussed in that statutory update and judicial pronouncement, I have already uploaded a video and the link will also be provided in this particular video ka description so that you can cross connect that. Now majority amendments are already covered in the lectures. Then whatever is the notification issued then after is already covered by this video, which were issued for September 25 students. Now ICI has issued statutory updates for January 2026 students. Now this statutory updates are covering those amendments also, those notifications also, which were released in September 25 PDF. So whatever were discussed in September 25 PDF, I am not going to discuss again. Whatever is the remaining or the balance amendment, balance notification, that I will be discussing in this particular video. Okay. So for the student appearing in January 26, the lectures plus that amendment video which I have issued, which were already covered in the lecture. Then September 25 video for statutory update and judicial pronouncement, and this particular video. These three videos are applicable to you. Now directly moving to this statutory update parts. First of all, there is no amendment in the sections. Understand, statutory updates means the amendment regarding notification or circular which are released after the ICI material is released, but applicable to your exam. First of all, what is the changes? The first one is in the capital gain chapter. Capital gain chapter, there is a section 54 EC we all are aware about, that if we transfer any immovable properties and within 6 months from the date of transfer, we purchase minimum 5-year redeemable bonds of NHAI, RECL, Power Finance Corporation or Indian Railway Finance Corporation, then long-term capital gain or whatever is the amount invested, or rupees 50 lakh, whichever is lower, that much will be the exemption available against our capital gain, that is long-term capital gain. Now in this particular list of the bonds, two more bonds are added. Two new bonds are added over here. The first one is HUDCO, Housing and Urban Development Corporation Limited, which is issued on or after 1st April 2025. So if the bond is issued prior to 1st April 2025, that bond is not eligible for 54 ECA exemption. But if the bond is issued on or after 1st April 2025, it is eligible for 54 ECA exemption. So let's say I have transferred my immovable property somewhere in January 2025 or February 25 or March 25. That is in the financial year 24-25. But can I say 6 months from the date of transfer, I can purchase these bonds? So I have a option to purchase the bonds of Hudco also, which is issued on or after 1st April 25 to get exemption against the capital gain arised in the previous year 24-25. The second one is IREDA, Indian Renewable Energy Development Agency Limited, but this bond should have been issued on or after 9th July 2025. Now please understand, if the capital gain is somewhere in the month of January, February or March, I can, if the capital gain let's say is in the March, I can still use this particular bond. In the statutory update PDF, this particular bond is not mentioned, which I have mentioned additionally, because this is also issued by CBDT much prior to this particular statutory update PDF is released. So two bonds are added to this list. First is Hudco on or after 1st April 2025. Second one is IREDA with effect from 9th July 2025. Then with regards to the chapter TDS TCS advanced tax. So if you see, this is the summarized version of your PDF and this is the main PDF. In that first one is regarding capital gain, which I have just discussed. The second one is all about chapter TDS TCS and advanced tax. Now this chapter I'm not supposed to discuss much. The simple reason, there are total 6 statutory updates with regards to this chapter. The first one covers all the particular declaration to be given by a unit in ATLA, that is IFSC. The second one is also about the same IFSC unit. The third one is also about 194N, cash withdrawal exemption. The fourth one is about notification with regards to some more exemption under 197A, that is no TDS, less TDS. All these particular 5 points are already discussed in September 2025 video, and hence I'm not supposed to discuss in detail. For that you have to refer that video. What is new? 6th point. It was not there in September 25 video, which is waiver of the levy of interest under 201 subsection 1A or 206C subsection 7. Now we all are aware about that what is the due date of depositing the TDS? 7th of the next month. So let's say I have deducted the TDS in the month of April. I have to deposit to the government up to 7th May. It may be possible that a assessee has paid the TDS amount to the government before 7th May, that is up to 7th May. The money is debited from the bank account, but we all are aware about that must be system failures, and because of that the challan is not created. Central government has received this money somewhere on 8th May or 9th May. It was there in the cycle somewhere in between. So if you see from the viewpoint of central government, money is not received. If you see from the viewpoint of the taxpayer, the money has been paid. Actually interest should not be there, but as per central government, money is received after 7th May. So they will issue the order to pay the interest at the rate of 1.5% per month or part thereof from the date on which it was deducted till the date on which it was paid. And that 1 month or 2 month interest has to be paid by the deductor, even though money is debited from the bank account up to the due date. So this is a very genuine case, and hence the relaxation is given that if this kind of case has arisen and the demand is received by the deductor for interest, he's not supposed to pay the interest. He's supposed to make an application to the authority that these are the particular screenshots, these are the evidences that from my bank account money has been debited up to the due date. You have not received. It's not my fault. Interest should not be there. The higher authority will verify your claim, and if your claim is genuine, they will waive your interest. Now what if this circular came before that you have paid the interest, but actually it was not payable? Then once this circular is in effect, you can again make an application for the waiver. Even though you have paid the interest, they will give you refund of that interest. So to both the cases, this particular circular is applicable. See what they are saying. Interest at the rate of 1 या 1.5% is applicable on non-deduction या non-collection or non-payment of TDS TCS. However, circular number 5 2025 gives waiver of such interest if, what are the conditions? Payment of TDS TCS has been done to central government initiated by the deductor या collector. Amount is debited from the bank account on or before the due date. This is the must condition. From your bank account, amount should have been debited up to the due date, but tax has not been credited to central government before the due date due to technical glitch. Application for such waiver to be done to whom? Chief Commissioner of Income Tax or Director General of Income Tax or Principal Chief Commissioner of Income Tax. Application to be done within 1 year from the end of the financial year in which interest is levied, means the year in which you have received this demand notice, from the end of that financial year up to 1 year, you can make this application for the waiver. And that application is to be disposed by the authority within 6 months from end of the month in which application is received. So this time limit must be clear to you. Let's say I have received the demand notice in the financial year 24-25 for which I want a waiver. I should be making this application for the waiver up to 31st March 2026, 1 year from the end of the financial year in which interest is levied. Let's say I have made an application in somewhere February 2026, which is much before the time. That higher authority to whom I have made the application should approve my application or reject my application. Order has to be passed within 6 months from end of the month in which application is done. So February 26 is the month in which I have done the application. So 6 months will get completes on March, April, May, June, July, August. 31st August 2026. 31st August 2026 will be the last date up to which this authority has to pass the order. This order shall be final. It cannot be appealed. So you cannot do any kind of appeal against acceptance or rejection afterwards. If interest already paid, still after this circular is in effect, and this is effective from 28th March 2025, waiver application can be done and paid interest will be refunded. So if the interest is already paid up prior to this date, because no waiver option was available, so you must have paid the interest. After this particular circular, you can make an application for the refund. They will give you refund also. So that was a good circular with regards to technical glitch, and this can be important for the examination. With regards to assessment procedure chapter, one small amendment, not much important, but still. You all are aware about that 139AA mandates the assessee to quote Aadhaar number at two places. One, PAN card application. Second, while filing income tax return. Aadhaar number is to be quoted except by that 4 persons: resident of Jammu Kashmir, Assam, Meghalaya, non-resident, not an Indian citizen, very senior citizen. These are the 4 exceptions. Apart from these 4 persons, each and every person has to mention Aadhaar number at two places. One, PAN card application. Second one, while filing income tax return. Now what if I'm not having my Aadhaar number at that time? I have to go to Aadhaar center first. I have to make an application for Aadhaar, and I will get one enrollment ID, 28-digit enrollment ID. This enrollment ID I have to quote in this PAN card application or in income tax return. It was allowed. I repeat, it was allowed. That instead of Aadhaar, you can mention your enrollment ID also. But in the second budget, which was issued on 23rd July 2024, now it is cleared that from 1st October 24, you cannot quote enrollment ID. Compulsory Aadhaar number is to be quoted. And those who have already quoted enrollment ID, a particular date will be mentioned. Up to that date, they have to mention their Aadhaar number to that authority. That I have quoted my enrollment ID, now I have received my Aadhaar number, and this is my Aadhaar number. So those who have mentioned the enrollment ID prior to 1st October 24 has to quote their Aadhaar number to whom? To PDG systems, that is Principal Director General Systems, or DGIT, that is Director General of Income Tax Systems, up to 31st December 2025. If up to this particular date Aadhaar number is not mentioned, then their PAN card will become suspended, their return will be nullified, that particular effects will be there. So that 31st December 25 due date you have to remember mainly. So far as the chapter penalty offenses are concerned, there is one entire big concept which is introduced, compounding, that is already discussed in September 2025 video, which is the most important topic, and you have to refer that video for this. The entire compounding topic is already discussed, so I'm not discussing again over here. So far as tax audit chapter is concerned, you know tax audit report 3CA 3CD, 3CB 3CD. Those who are supposed to be audited under any other act, the audit report will be 3CA, annexure will be 3CD. And those who are only supposed to get audited under Income Tax Act, the audit report will be 3CB, annexure will be 3CD. 3CD is having so many clauses. Few clauses has been changed from this financial year. Means from the financial year 24-25 ka 3CD report, few clauses are having some kind of amendments. The first amendment is in clause number 22 of this 3CD report. Earlier there were 2 subclauses. Now there are 3 subclauses within this clause. The first one, you have to mention amount of interest which is inadmissible as per section 23 of MSME Development Act. That over earlier also. So whatever interest is paid to any person who is registered under MSME is disallowed, and that we have to mention under 3CD also. Now the second point which we have to mention is total amount required to be paid to micro or small enterprise as per section 15 of MSME Act. So you all are aware that there is a section 43B clause H under PGBP, that if you pay any amount to a person registered under micro or small category, and if the payment is done up to the due date of MSME Act, it is okay. If the payment is done after the due date of MSME Act, the expense will be disallowed and it will be allowed in the year in which it is paid. So first we have to mention over here that what is the total amount which is to be paid to micro or small enterprise. So payable amount is also to be included over here. And in the third subclause, we have to give now two bifurcation. Whatever amount you have written in clause 2, from that how much is actually paid up to the due date, how much is not paid up to the due date. Now whatever you will write in this not paid up to the due date, please be aware it may lead to litigations, because that much will be disallowed under which section 43B clause H if not paid during the previous year also. So this disclosures are added which will be important for the exam also, because 43B clause H in itself is an important clause, and with regards to disclosure you have to remember this clause 22. So many students have asked me that, sir, in audit report whether we are supposed to remember each and every clauses. Beta, no, it is not possible. But at least the important sections, whatever clauses are relevant to important sections like 269 SS, 269T, 43B clause H, this kind of 48 2B, this kind of all the things you have to particularly remember. Clause 26 is all about the disclosure requirement with regards to 43B. That what are the expenses covered by 43B, whether it is paid up to the due date of 139(1), how much is not paid, how much earlier expense are paid during the year, all that disclosure are there. The point is as it is, only one change is there. Now this point will not be applicable to the disclosures of 43B clause H, because that is already covered under clause 22. Then with regards to clause 31 subclause A, B and C, that is all regarding 269 SS, 269T. If any loan, deposit or specified sum taken or accepted more than 20,000 otherwise than by account pay, check, draft, TCS or other electronic mode, can I say it will lead to 100% penalty. Similarly, 269T, if the opening balance of loan deposit specified sum is 20,000 or more, you cannot repay any amount otherwise than by banking method. Otherwise, it will also lead to 100% penalty. The disclosure is to be given in clause 31 of 3CD report. Now in this they have added some detailed disclosures. For each and every loan or deposit taken or accepted, now you have to mention the code of the nature of the amount. The code is to be mentioned. The code number is defined A to L, cash payment, cash receipt, non-account paycheck, non-account paycheck receipt, transfer of asset, transfer of liability, conversion, journal entries, any other mode. So you have to select code for each and every loan ka repayment and each and every loan ka acceptance. A new clause is added, 36B. This can be important for you. 36B clause is added because a new section is added in the Act, 222F. On or after 1st October 2024, if any domestic company buy back the shares, then whatever amount is paid to the shareholder, company is not supposed to pay the tax. Now the tax is to be paid by the shareholder. First as a deemed dividend under income from other sources, section 222F, without any kind of deduction of expenditure, because 57 deny any kind of expense against 222F. Simultaneously, capital gain will also be taxable, wherein the full value of consideration will be 0 as per 46A, and whatever is the cost that will be deducted. So in the case of buyback on or after 1st October 24 by a domestic company, to the shareholder two implications will be there. One, taxability of IFOS. Second, there will be a capital loss. Disclosure is given by auditor under form number 3CD, clause 36B. 3 points you have to give answer of. First, whether amount is received under 222F, that is buyback on or after 1st October 24, either it will be yes or it will be no. Drop down is given. Second, if the answer is yes, then you have to give two things. Amount is received under 222F, that is buyback on or after 1st October 24, either it will be yes or it will be no. Drop down is given. Second, if the answer is yes, then you have to give two things. amount of that buyback received and what was the cost of the shares. This disclosure is to be given by the auditor under this particular clause. So these were the changes in the 3CD report. So far as non-resident taxation chapter is concerned, there were many points in this chapter, like there were section 44 BBC, cruise ship related presumptive taxation. So what is the eligible cruise ship? That I have already discussed in September 2025 video. Second, transfer pricing chapter. Transfer pricing chapter contains 3 amendments. And now this is something very important. The first point is regard to safe harbor rule. Now what is safe harbor? Let me discuss first of all. So we all know that whenever you are doing any kind of transaction with an associated enterprise and the transaction is an international transaction, the transaction has to be done at arm's length price. And for that arm's length price, assessee will decide what should be the arm's length price. The auditor will certify that. And then transfer pricing officer can also create the disputes on the assessment. But if you want to avoid this kind of dispute, there are 2 options available with you. One is APA. What is APA? Advanced Pricing Agreement. Wherein you make an application to the income tax officer that this is the transaction which I am going to incur, or this is the transaction which has already been incurred, and this is the arm's length price that we are deciding. Now you tell us whether it is acceptable or not. If not, then you suggest what should be the arm's length price. That we will show in our income tax return, and then no dispute will be created. This that advanced pricing agreement is one kind of advanced ruling for this arm's length price. The second option, wherein you no need to make any kind of question answers and all, there is a fixed transactions, that if you enter certain transactions, government has issued kind of presumptive arm's length price, that you adopt these prices, we will not create any kind of dispute. And these rules are called as safe harbor rules. So if you incur, see, these safe harbor rules are not applicable for each and every transaction. It is applicable only for those transactions which are mentioned in this safe harbor rules. If you are incurring this few transactions and the few conditions as per the rules are satisfied, whatever they are saying, adopt that particular percentage, adopt that particular amount as your arm's length price, and now no dispute will happen. But if you want to apply for safe harbor rules, you have to just make an application that okay, I'm going to adopt the safe harbor rules, and income tax authority will generally accept that okay, unless and until they think that your transaction is not covered by these rules, then only they can reject. Otherwise generally they will accept. Now what is the difference between advanced pricing agreement and safe harbor rules? Advanced pricing agreement covers each and every transaction, and that is personalized. Case to case basis it will change. Safe harbor rule is a general set of amounts that is applicable to each and every assessee following those transactions mentioned in that safe harbor rules. Advanced pricing agreement, you have to pay a heavy fees for this agreement. Safe harbor rules are free of cost. You just have to make an application in the form that I am going to apply for these rules. Now safe harbor rules are issued for 3 things. Number 1, specified domestic transaction, milk production companies and all, that are already discussed in the lectures. Second one is regards to section 9 income. Deemed to accrue or arise in India. If you have a business connection in India, income will be taxable in India, but not entire income. Only income attributable to the operations done in India, that much will be taxable in India. For that particularly diamond industry, they have issued safe harbor rules that how much percentage you have to disclose, so that will not do any kind of dispute. That already discussed in September 2025 video. And the third one is regarding all other transfer pricing adjustments. Normal transfer pricing transactions, normal international transactions, for that also safe harbor rules are now issued, and that will be discussed in this video. It is not there for September 25, it is there for January 26. It is easy, but the main purpose for this video is this safe harbor rules only, because these are damn important for your exam. So 3 kind of safe harbor rules are there now for you. One regards to specific domestic transaction. This is already discussed in the lecture, a small topic. Second one is how much income is attributable to Indian operation with regards to section 9. For that also, diamond industry safe harbor rules are applicable. September 25 video I have already discussed. Third, with all other international transaction, that is not all other, few international transactions. Now safe harbor rules are applicable. If assessee wants, he can adopt. If he don't wants, he can decide arm's length price on its own, and then he has to prove in the dispute and litigations and all. So this is one kind of presumptive taxation. If you don't want dispute, you can adopt this. It is not compulsory for you. So that safe harbor rules we are going to discuss in the third point. But whatever was the safe harbor rules for the section 9, that was already discussed in September 25 video. Now before I move to safe harbor rule, first there is one other amendment also. Not amendment, notification. With regards to section 94B. Now what is section 94B? You know, whenever you are an Indian enterprise or a permanent establishment of a foreign company, you are going to pay interest to any associated enterprise who is basically outside India. Whatever is your interest expense, above 30% of your EBI TDA, that will be disallowed. That is as per action plan number 4 of BEPS. And that excess interest will be carry forwarded. That can be allowed in the subsequent year if the interest expense is lower than 30% of EBI TDA. So 94B basically restrict allowability of interest expense claimed by Indian company or permanent establishment of a foreign company in India. But there is one exception. That exception was given by the budget issued on 23rd July 2024. A finance company which is in IFSC, that is Gift City, is excluded from this section if it fulfills the following condition. A finance company in IFSC excluded from this section if fulfills the following conditions. So if I am in a gift city, I am a finance company, my main expenditure will be of interest expense. Then that expense can be allowed totally without disallowance of 94B, provided I am a financial institution separately registered and carrying specific activities. I should not be a part of any company. I should be separately registered as a standalone independent company, independent organization. I should be carrying out specific activities which are now prescribed, which I am going to discuss in a while. Second condition, this finance company should not accept public deposit either from resident or from non-resident. It should not be registered with authority as a banking unit. It should not be a normal bank. The interest should be paid by such finance company being the borrower in respect of any debt issued by a non-resident shall be in foreign currency. So the associated enterprise which is in foreign country, that foreign country should pay amount to this finance company. This finance company is engaged in the specific activities. This finance company is paying interest to that associated enterprises, but that should be compulsorily in foreign currency. Then only 94B will not apply. If it is paid in Indian currency, yes, 94B will apply. Now this finance institution should carry out specific activities. Which activities it should carry out? Number 1, lending as a loan, commitment, guarantee, credit enhancement, securitization, finance, lease. Factoring of receivables, the functions of global or regional corporate treasury center. So you can understand that it's a finance company of that multinational group which is providing kind of finance to other entities, kind of factoring of receivables of all the associated enterprises, and interest is being paid to associated enterprises somewhere by taking the loan, etc. Then it is okay. The 94B section will not apply. Now important discussion regarding safe harbor rules for arm's length price under section 92C or 92CA. See, no method will be applicable. Cup method, resale price method, cost plus method, transactional net margin method, profit split method, as any other method of CBDT, not a single method will be applicable if you adopt safe harbor rules. But as I said, safe harbor rules are not for each and every transaction. It is for the few transactions mentioned in the notification. So 3 kind of safe harbor rules are there. Specified domestic transaction, already discussed in the lecture. Section 9 diamond industry related rules, already discussed in September 25 video. Third one is what other specific international transaction. Now I am going to discuss. As per 92 CB, arm's length price shall be subject to safe harbor rules. Safe harbor rules means circumstances in which income tax authorities shall accept transfer price or income deemed to accrue or arise in India, as the case may be, declared by assessee. Section 92 CB empowers the CBDT to prescribe safe harbor rules. Now that is prescribed. Rule 10 TD read with Rule 10 TA and 10 TB and 10 TC. Okay. If you are eligible assessee, you are entered into eligible international transaction, and if the option is exercised, it is not held as invalid, then the transfer price declared by assessee for such transaction shall be accepted by income tax authorities if it is in accordance with the circumstances mentioned below. So assessee should be eligible, who is doing this international transaction mentioned over here. Only those transactions should have been entered which are mentioned over here. Assessee has applied for this by filing a separate form, and that has not been rejected by income tax officer. Then whatever is the arm's length price declared by assessee in accordance with this, it will be full and final. Assessee will also accept it. Income tax officer will also accept it. No dispute will happen then after. So you see, government is trying very hard to reduce the dispute by having this kind of advance ruling, advance pricing agreement, safe harbor rules. So these things reduces your litigations then after. Now what are the cases covered over here? I have tried to simplify this in a tabular format as much as I could. I have removed all those things which are not relevant for you. I have added all those things which are relevant for you, and this table will be each and everything that is safe harbor rules, which are there for around 30 pages in that PDF. I have tried to cover here in 3 pages, and that has been covered. First of all, two transactions they have mentioned: provision of software development service or provision for information technology enabled services. You are an Indian organization which is providing software development services to your associated enterprises. Or the second transaction is, you are an Indian enterprise who is providing information technology enabled services to any associated enterprises. You must be incurring operational expense, and you have to declare your operational profit on that, and that should be at arm's length price. So the pricing at which you are selling these services, providing these services, has to be minimum at certain level, and that minimum profit percentage is prescribed. If the transaction is up to 100 crore, your operational profit margin to operational expense, that is operational profit divided by operational expense, has to be minimum 17%. If it is minimum 17%, it is at arm's length price. If the transaction is more than 100 crore but up to 300 crore, then at least you have to declare 18%. Your profit margin with regards to base of operational expense has to be 18%. What if transaction value is more than 300 crore? Safe harbor rule is not applicable for you. For that you have to go in normal manner. So two kind of services are covered over here: provision of software development services. So you are providing software development services to outside India associated enterprises, or any information enabled services outside India to associated enterprises. Your operational profit divided by operational expense, that ratio has to be not less than 17% if the transaction is up to 100 crore. If it is more than 100 crore rupees or up to 300 crore, it will be 18% minimum profit margin. Acha, this does not include research and development services. So if research and development service is there, safe harbor rule is not applicable for that point. But it includes system support service. So any kind of system support service is included over here. Then the third one is provision of KPO, knowledge process outsourcing service. So you are a KPO and you are providing services to your associated enterprises. In the business of KPO, one of the main expenses is employee cost. So they take the contract, they hire the employee do the work, they charge the fees for that. Now, if the employee cost in relation to your total operating expense is less than 40%, so whatever is your total operating expense, your employee cost is less than 40%, then your operational profit divided by operational expense, that profit margin has to be minimum 18%. Whatever you are charging, it has to be with minimum 18% profit margin. If the employee cost is more than or equal to 40% but less than 60% of the total operational expense, so let's say my total operational expense is assuming 60 crore. Now out of this 60 crore, if my employee cost is let's say 30 crore. So can I say out of the total operational expense, employee expense is more than or equal to 40% but less than 50%, because mine is exactly 50%. So now I have to charge to that associated enterprises total 60 crore, that is operational expense, plus minimum 21%. And that much should be at least my operational revenue. That will be arm's length price. So the profit margin on operational expense has to be how much? 21%. And if the employee cost in relation to operational expense is more than or equal to 60%, then yes, now my profit margin has to be 24%. This different rates you have to remember. So if you are providing any kind of KPO service to associated enterprises, your employee cost in relation to total operational expense is up less than 40%. Minimum 18% has to be your profit margin. 40 to 60% employee expense, then minimum profit margin has to be 21%. More than or equal to 60% employee cost, then minimum profit margin has to be 24%. And value of transaction should be less than or equal to 300 crore. If your transactional value is more than 300 crore, safe harbor rule is not applicable to you. You have to determine arm's length price as per the normal provisions. And this profit margin is not with regards to sales. It is under the base of operational expense. It is operational profit divided by operational expense. Again, this don't include research and development service, but it include system support service. That is okay. Fourth one, which is very common. And by giving this in safe harbor rules, majority litigations are reduced. Advancing intra-group loan, which is denominated in Indian rupees. You are an Indian enterprise. You are giving loan to associated enterprises. Then how much minimum interest you should charge? If you are charging the lower interest, then by adopting arm's length price, the higher one will be added. So how much minimum interest you should charge? So that will be accepted as arm's length price. But this fourth point is applicable when the loan is denominated in what? Indian currency. Interest rate should not be less than minimum this much interest you should charge. First, you have to see that what is the rating of that associated enterprise. So if that person is having good rating, then interest will be lower. If that person is not having good rating, interest will be higher, obviously. So what is the rating of that associated enterprise? If that associated enterprises is having a debt rating, CRISIL rating of AAA to A somewhere, AAA, minus A, double A, etc., then your interest has to be 1 year lending rate of SBI on the 1st April of the previous year. So whatever is that SBI का 1st April का lending rate plus 1.75%. So let's say SBI lending rate on 1st April of the previous year, that is 1st April 2024 for our exam, is let's say 6%. Then to your associated enterprises who is having this kind of rating, you will charge 6% plus 1.75%, that will be 7.75%, and it will be assumed at arm's length price. If the rating of that associated enterprise is BB minus, BBB or BBB plus, triple B minus, triple B or triple B plus, then whatever is the SBI ka rate, in my example 6% on the 1st April of the previous year plus 3.25%. If the rating is getting lowered, it is either BB to B, then it will be that SBI ka 1st April ka lending rate plus 4.75%. And if the rating is worst, C to D somewhere, then it will be SBI का 1st April का lending rate plus 6.25%. This will be the minimum interest that you should charge over here, and you should show it as your income. Safe harbor rule is mainly related to your income. If you see, the first, second point is also how much minimum margin you have to charge. Third one was also how much minimum margin you have to charge. Fourth one is also how much interest you have to charge. Fifth one is also how much interest you have to charge. So it is mainly related to revenue, not related to expense. But what if the credit rating is not available of that associated enterprises? If no credit rating available and loan to intra group is in Indian rupee, and all the total loan is not more than 100 CR on 31st March, the additional interest that you have to charge is 4.25%. So whatever is the first year, 1st April ka SBI ka lending rate plus 4.25%. So this will change on every year because 1 year lending rate of SBI on 1st April will change on every year. So this rate of interest in total will also change every year. This additional rate will remain same. So very good rating, then 1.75%. Below that 3.25%, below that 4.75%, below that 6.25%. If no credit rating available, but total loan is up to 100 crore up to 31st March, then it will be 4.25%. Now this safe harbor rule is not applicable if advanced by the enterprise engaged in finance business, plus not including the loan with no fixed term repayment. So if I'm into a finance business only and I'm getting interest, this safe harbor rule is not applicable if the repayment is not fixed. But generally, if I'm a normal organization doing any trading, manufacturing kind of business, I'm just giving the loan to associated enterprises, charging the interest, I can adopt this safe harbor rule. In the exam, if any question is there and they are giving you the hint to find out ALP based on different adjustment, you can write an assumption that assessee has not opted safe harbor rule and calculate the arm's length price as per the normal methods. But if they have said you that assessee has opted for safe harbor rule, then only apply this kind of percentages. Now this particular fourth point was applicable when the loan is denominated in Indian currency. What if the loan is denominated in foreign currency? If the amount of loan to all the associated enterprises does not exceed 250 crore INR on 31st March, then this safe harbor rule will be applicable, and then the interest rate will not be less than this. First of all, understand the difference between fourth and fifth point. Fourth point was covering the loan which is in Indian currency. Fifth point is foreign currency loan. Fourth point don't have any limit. The loan can be of 1000 crore also. Still safe harbor rule is applicable. Fifth point is applicable only if that loan amount is up to 250 crore. If it is beyond 250 crore, safe harbor rule is not applicable. Now, if the loan amount on 31st March of the previous year is up to 250 crore, and if the loan is in foreign denomination, then what is the minimum interest that you should charge? Then see what is the credit rating of that associated enterprises. If it is between AAA to A minus, then whatever is the reference rate of relevant foreign currency on 30th September of the previous year. Now, what is the meaning of reference rate? That is also defined, that I am discussing in 1 minute. But whatever is the reference rate on 30th September of the previous year, plus you have to add 1.5%. Now, if the credit rating of that associated enterprise is BBB minus, BBB or BBB plus, then whatever is the 30th September ka reference rate of that particular foreign currency ka plus 3% you have to charge. And if the worst rating BB plus 2D, so instead of 4 category, now here in only 3 category, then the addition that you have to do is 4%. If the amount of loan to all the associated enterprises exceed 250 crore, it exceed 250 crore, then the interest additions will be something like this. So now you understand that this particular safe harbor rule is not applicable if the loan amount is more than 250 crore. For that, some different safe harbor rule is there, wherein if the loan is denominated in Indian currency, there is only one table applicable. Even if the loan is below 250 crore, even if it is above 250 crore, same kind of interest will be charged. If it is in foreign currency, loan amount is up to 250 crore on 31st March, this will be applicable. If the loan amount on 31st March is total more than 250 crore, minimum this much interest you have to charge. If the credit rating of that associated enterprises is AAA to A minus, whatever is the relevant reference rate on 30th September of the previous year, plus 1.5%. If BBB minus, BBB or BBB plus, it will be plus 3%. BB plus 2 BB minus, it will be plus 4.5%. Worst rating, yeah, rating not available, then it will be 6%. Now the only question is, this rate is to be added into 30th September ka reference rate. Then what is the meaning of reference rate? If your loan is denominated in US dollar, then the reference rate means 6 month secured overnight financing rate, that is SOFR, plus 0.45%. So let's say I am an associate, I am a company giving a loan in US dollar. Loan is denominated in US dollar, let's say. And the loan amount of all the associated enterprises is up to 250 crore. The associated enterprise is having the rating 1118 to A minus. Then first I have to get that 30th September का SOFR, US का basically जो rate है वो SOFR, plus I have, let's say that is 4%, assuming, plus I have to add 0.45%. This will be called as reference rate because they have said it is 6 month ka SOFR plus 0.45%. This is the reference rate, plus I have to add 1.5% as per this safe harbor rule. And this total, that will be 5.5 plus 0.45, 5.95% will become my arm's length price. This is minimum interest that I should charge. Similarly, let's say if the loan is denominated in euro, then it will be 6 month euro interbank offered rate plus no addition plus whatever is given in safe harbor rule. Here no separate addition is there. If it is on UK pound sterling, then 6 month sterling overnight index average Estonia plus 0.30% plus whatever addition they have said in safe harbor rule. If it is Japanese yen, 6 month Tokyo term risk free rate TORF plus 0.10%. Australian dollar 6 month bank bill swap rate, that's it, plus whatever addition as per safe harbor rule. Singapore dollar 6 month Singapore overnight rate average plus 0.45%. LIBOR has been removed. Earlier in safe harbor rules, which were there 2 years prior, they have given the reference of LIBOR. But now all the different currency ka rates they have mentioned over here. Somewhere they have done some more additions also in that rate to get it adjusted. And plus this rate addition is so done compulsorily. Sir, whether we have to remember all this? Obviously. But it's painful to say this, but yes, you have to remember this. There is no other option. I'm sorry for that. I have summarized already whatever I could, but this much to minimum you have to remember. Then, what if you are a enterprise which is providing corporate guarantee to your associated enterprises? Now, what does that corporate guarantee mean? Corporate guarantee means explicit corporate guarantee extended by a company to its wholly owned subsidiary, being a non-resident, for any short-term or long-term borrowing. So you are an holding company into India. You have a wholly owned subsidiary outside India. That wholly owned subsidiary outside India is taking loan somewhere, either short-term or long-term, and you are a guarantor for that particular company. So if you are giving guarantee, you cannot give it free of cost. You have to charge some minimum commission. How much minimum commission should be charged? If the guarantee amount is less than or equal to 100 crore, or it is more than 100 crore, but rating is adequate, in that case you have to charge minimum 1% per annum of the amount guaranteed as the commission. So if the loan amount is up to 100 crore, 1%. If the loan amount is more than 100 crore, safe harbor rule is only applicable if the rating is adequate of that associated enterprise. In both the cases, the commission that you can charge is 1% per annum for the amount which is guaranteed. This safe harbor rule is only applicable to those guarantee charges which is payable from, means received from, wholly owned subsidiary. If the guarantee is for any other associated enterprises which is not a wholly owned subsidiary, safe harbor rule is not applicable. You have to calculate arm's length price in accordance with the normal methods. Then, if you see in the first, second, and third point with regards to software development service, IT enabled service, and knowledge processing outsourcing service, they have excluded research and development activities because it is separately covered over here. You are an Indian organization doing research and development for software development or provision for contract of research and development to generic pharma drugs. So either so far as software industry is concerned, you are doing research and development for your international group, or pharma drugs making manufacturing companies concerned, you are doing research and development. And you are providing that research development services to your enterprises, associated enterprises. How much minimum you should charge? If the transaction value is less than or equal to 300 crore, then the profit margin that you should charge, that is operational profit divided by operational expense, minimum 24%. It should be minimum 24%. Then up to now, if you see, majority all the things were regarding services, not goods. So first three was of services, then it was interest, then it was guarantee charges, then it was research development service. Now it is manufacture and export core auto component. You are in Indian enterprises, you are manufacturing core auto components and doing export for any company outside India who will now prepare the motor cars and sell worldwide. So basically you are making that auto components, core auto components like engine parts, transmission, steering parts, suspension, braking parts, etc. The minimum profit margin you have to keep is 12%. Operational profit by operational expense has to be 12%. And what if you are manufacturing and doing export of non-core auto parts? Then minimum profit you should charge is 8.5%. Whatever is point number 1 to point number 8, it is all regarding income. They are not discussing about expense. They are all discussing about how much minimum income should be there. Ninth point is regarding expense. You are Indian enterprise. You are taking low value adding intra-group services from associated member. So you are Indian enterprises. Now you are taking services from associated enterprises. This is not essential services. These are subordinated services, support service, non-core service, etc. Then arm's length price is applicable for that expense also. You cannot pay huge expense for that. You have to pay a maximum certain expense. And how much you should pay? Or that safe harbor rule says that safe harbor rule is applicable only if this total value does not exceed 10 crore. If this exceed 10 crore, apply normal method. If it don't exceed 10 crore, then this safe harbor rule is applicable, and it says that the expense has to be with a markup of maximum 5%. So whatever is the cost to that associated enterprises, plus they can charge 5% at max. If you are paying a markup of 6% or 7%, it is not a safe harbor. So safe harbor says maximum 5%. That associated enterprises will charge maximum how much? 5%. But this safe harbor rule is applicable for this expense only if the value of the transaction does not exceed how much? 10 crore. This is with regards to the services given by one of the members of the group to other. But it does not include research development. It is not other activity, manufacturing services, IT service, knowledge process, business process, insurance. These services are not covered over here. For that you have to follow normal ALP methods only. So first 8 pointed with regards to interest, software management, IT enabled services, Indian currency interest, loan given, then foreign currency denominated loan ka interest, guarantee fees, manufacturing and doing export of core auto parts, non-core auto parts. And finally, we saw the expense. That is, you are taking some low value added services from associated enterprises up to 10 crore, then with a markup of maximum 5%. What is the meaning of operating expense? Because in majority things they have described what should be the minimum profit margin, and that profit margin was operating profit divided by operational expense. Then operating expense means cost incurred by us in relation to international transaction during the course of normal operation, but it exclude what is not counted in that operating expense: interest, provision of uncertain liability, pre-operating expense, foreign currency fluctuation loss, extraordinary expense, income tax. So these things are obviously indirect expense. They are not direct expense. Operational expense is basically direct expense. So these things are indirect expense, and hence they are not to be counted for counting that minimum profit percentage. What is the process for this? Assessee will file an application to assessing officer up to the due date of 139 subsection 1 in form number 3CEFA that I want to adopt this safe harbor rule for this particular transaction. If option is to be exercised for more than 1 year, so you have an option that you can adopt safe harbor rule by filing one form for consecutive years, maximum 3 years. After 3 years, again you have to file the form. So by one form, either you can adopt for 1 year or 2 years or maximum 3 years. Then if you want to adopt safe harbor rules for 3 years, form has to be filed in that first year ki 139(1) ki due date. It cannot be filed in the second year with retrospective effect. No, it is not advance pricing agreement. Rollback is not applicable. Compulsory, it will be applicable from the year in which it is filed, that is from the year for which it is filed, and then after for more 2 years. In total, 3 years. Option can be exercised for maximum 3 years. AO will verify such form, and if he has a doubt, then reference shall be made to transfer pricing officer. Reference can be made maximum up to 2 months from the end of the month in which form is filed. Now, transfer pricing officer may issue the notice to call for the document to verify whether the transaction is genuine or not. If TPO wants to reject, it can do so maximum within 2 months from end of the month in which reference is made by AO. On rejection, assessee can file an objection with Commissioner of Income Tax within 15 days of the receipt of the order. And now CIT will finalize the things within 2 months from the end of the month. So everything is within 2 months from end of the month. In general cases, that will be accepted by AO. Only in few cases, reference is to be made to TPO. Otherwise, whatever form you are filing, generally it will be accepted and dispute will be removed. And see, whatever they have said is actually high income only. Very few people will adopt safe harbor rules because see, the profit margin that they are saying 17%, 18%, 21%, 24%. See the interest rate that they are saying us to charge. It's a huge amount. So only if I want to play very safe, I will go for safe harbor rule. Now some important things are there. Once safe harbor is exercised, that variation, that 3% or 1% variation can be done is not applicable. Compulsory this value will be your ALP. Acha, the moment you are following safe harbor rule, litigation will not happen. But that does not mean that you are free from all the requirement. Documentation has to be maintained as it is, as you were supposed to maintain. Documentation are as it is required. Safe harbor is not applicable if transaction with the entity located in notified jurisdictional area as per section 9A. Because we have some special grudges against those people and hence safe harbor rule is not applicable. Acha, once you adopt safe harbor rule, litigation cannot be done. Now, as per DTAA, whatever is the MAP procedure, mutual agreement procedure, even that is also not applicable. So, assessee will not be entitled for MAP, that is mutual agreement process, if safe harbor is accepted. Now, you cannot raise any kind of dispute within India, outside India. Totally debarred from that. So, this is all about safe harbor rules that is applicable to you people for January 26 attempt. Please focus more and more on capital gain chapter first, buyback provisions, those which are amendments. Please have a maximum focus on that. Those students appearing for January 2026 students, you are having plenty time. Your direct tax is never completed if these things are pending. Means if these things are done totally, then your DT is completed. What are these things? First of all, the notes which I have given to you, plus entire ICAI module ka question answers, not a single question has to be left, plus model test paper of ICAI. Don't go for any author ki question book. Don't go for any kind of external materials. They all are made up from ICAI materials. Then why not directly doing from ICAI material? ICAI is each and everything for you. Whatever ICAI is saying is final for you. So model test paper, plus you have to do RTP of at least 4 attempts, plus you have to do mock test papers also, plus the case study booklet which is issued on ICAI Board of Studies portal, plus past papers, at least 4 attempts. Guys, if these are done na, then you are done with DT. But then along with this, writing practice is also required. Many students don't do writing practice. Then how you would appear in this 3 hours of paper? Our examination system is such a weird system that it judges a student within whatever you have written in that 3 hours, and whatever you will write in that 3 hours, the result will be based on that only. Don't forget that. Solving the questions orally will not give you marks. Writing that will give you the marks. So at least 3 papers you have to write completely with good presentation in a timely, proper manner. Case study are to be solved because then only you will be able to understand the linkage, that how to be solved, in what time to be completed and all that stuff. So these things are to be done. Once this is done, plus those 3 videos, that is, one is amended video, second one is September 25 statutory update judicial pronouncement, third one is January 2026 statutory update video, that is this video, and the last one, if judicial pronouncement of your attempt is issued, I will issue a further video also on that. That much you have to do completely. With this, all the very best for your examination. This video is completed. Thank you so much.